Is the United States heading into a recession? And if so, what does that mean for our local Central Virginia housing market? We'll cover that today in your October 2025 housing market update. What is going on, party people? My name is Chris Elliott, local realtor here in Central Virginia since 2013, 550 home sales under my belt. And in today's video, we're going to break down what's happening in the US economy at large and what that in turn means for our local housing market. Let's jump into it. Currently, job growth has been stalling out and the inflation rate remains elevated above the Federal Reserve's target 2% inflation rate, with some experts saying that the worst is yet to come with tariff-driven inflation on the way. And you might be saying to yourself, hey, Chris, thank you for bumming me out, but what does this all mean to our real estate markets? Well, specifically, employment and inflation have major effects on mortgage rates, which of course have a huge effect on our housing market. Let's break that down. So the Federal Reserve is the government entity or quasi-government entity, if you wanted to get into conspiracy theories, which we won't do in this video today, but the Federal Reserve sets the federal funding rate, which is the rate in which banks borrow money from each other. Now, the Federal Reserve doesn't directly control mortgage interest rates, but of course they influence or affect mortgage interest rates. You know, they're kind of a little upstream. The rate at which banks are able to borrow money in turn affects the rate at which banks are willing to lend money out, because of course they want to have a profit margin in there. So when you hear people talking about the Federal Reserve cutting interest rates, what they're talking about, or what that really means, is that the Fed would cut the federal funding rate, which in turn influences the retail mortgage rates that you and I would see if we went down to our local bank and wanted to take out a mortgage. All right, so also important to note is the Federal Reserve has a dual mandate from Congress that they need to maximize employment. So we want to see, Congress wants the Federal Reserve to minimize the amount of people that are unemployed, and they want inflation to be under control. So they want prices to remain relatively steady so that the economy stays steady. So that is a tough balancing act for the Federal Reserve, and a lot of times now included because there was a recent jobs report that came out that was absolutely terrible, that would indicate, hey, the Federal Reserve needs to cut rates so that business activity can resume, businesses can start borrowing money and hiring people. But at the same time, they know that if and when they do that, it's going to cause inflation to continue to rise, and we're already at a place right now above where they would prefer to see it. All that being said, the Federal Reserve understands and realizes they have gotten to a place where they have to start cutting the federal funding rate. It's widely believed they are going to start incrementally cutting the federal funding rate so that interest rates that you and I would see if we wanted to go borrow money would begin coming down. With that being said, at the time of this recording, mortgage rates have actually already come down in anticipation of the Federal Reserve cutting the federal funding rate. So rates were at 6.5%. They're currently at 6.27% for a 30-year par interest rate that you and I would see if we went into a bank at the time of this recording. That all that finance nerd speak is cool, but you might be asking yourself, all right, when are we actually going to get into how this affects us in our local Central Virginia market? Well, let's tie it all in. All right, so here's where we're at right now in our local market. Although we are not seeing the rocket ship of appreciation that we saw during COVID, we're still at 3.8% year-over-year appreciation, or at least we were as of last month. Our days on market is still only 9 days, which is very, very quick. Home sellers are still getting 100% of their asking price on average. Yes, I'll say that again. Home sellers are still getting 100% of their asking price on average. And our month supply of inventory is currently at 1.6 month supply of inventory. If you've been watching my videos in the past, you know that month supply of inventory simply says at the rate at which homes are selling, how many months worth of inventory do we have? Anything below 6 months is considered a seller's market. So at 1.6 month supply of inventory, we're still in a red hot seller's market. So here's my personal prediction. If and when rates get down into the fives, and we could be at 5.99999, the second that that rate has a 5 in front of it, a lot of housing experts predict that there's going to be a psychological unlock in which people are going to be comfortable enough to trade in their 2 and 3% interest rate to make the move that maybe they've desperately needed to make over the last couple of years, but they haven't because they feel like it's too much of financial loss to give up a 3% interest rate to a 6, 7, or 8% interest rate. And I can tell you firsthand, I've had so many conversations with people that want to move, that need to sell, that need a bigger house, that want to downsize, but they're just kind of stuck psychologically. They feel like they couldn't make that move. It would be too much of a financial bad decision. And I just think the floodgates are going to open with inventory of people that want to buy buy that want to sell once those rates get down into the fives. So I think if and when we see that, my personal prediction is we're going to start seeing 5+% appreciation year over year in Central Virginia again. We're going to see a lot of inventory that's going to be unlocked and a lot of buyers coming off the fence that have been sidelining themselves. And I think that's honestly where we see our market, where I see our market going in 2026. All right, so what does this all mean to you? So here are the tips that we're currently giving to our prospective sellers as well as our prospective buyers. For sellers, TikTok. If you're watching this video, you're seeing it, or if you're watching this in the month of October, I will tell you that as we progress into the holidays, the market tends to slow down gradually until the end of the year. It doesn't really pick back up until February. Now, that's not to say homes won't sell, from November to February. We're going to sell plenty of homes, but it is a slower market. So if you're somebody that wants to get sold by the end of the year, I would encourage you to get your home on the market sooner rather than later. Secondly, pricing is critical, especially this time of year, given that the market is going to continue slowing down gradually. If you don't get your price right when you first go on the market, you're either not going to sell and you're going to have to wait until the spring market, or you're going to be making a price reduction in a potentially slower market. There's not the margin for error for pricing mistakes this time of year as there is maybe in the spring and the summer. So I would encourage you to make sure that you're pricing your property appropriately if you're going to be hitting the market this year. And last but not least, it's not the market. So I hate to break it to you, but if you are somebody that is on the market and are not getting the results that you want to see, it's not the market, it's not interest rates, it's not the economy, it's not the president, it's not the whatever. It is simply you are either overpriced, there's something about the condition of your home that's not working, or your home is being under marketed, right? Our market is still absolutely on fire. We are still cooking. So if your home is not selling, you got to take a hard look at the mirror and see what needs to be adjusted. For my buyers, get in front of the appreciation. Like I told you, we are predicted to see interest rates continue to drop. With that, we are going to see where home prices are not only going to continue to grow, but in my prediction, they're going to grow at a faster rate. So if you're somebody that is waiting until interest rates drop, I would encourage you to try to find a home before those prices go up, because you're going to have a double win. Number one, you're going to get in front of the price appreciation that's going to happen between now and the future. You're also going to be able to refinance down the road if you buy now, but you can't go back in time and renegotiate the sales price. Secondly, spring means more competition. So we have a lot of folks that say, hey, Chris, we're going to wait until the spring because we know more inventory comes in the market and therefore we're going to have more selection of homes. And I would absolutely agree with you there. But the other thing I would tell you is there's going to be more inventory to choose from, but there's also going to be more competition from buyers, especially if interest rates continue to go down. So realize that yes, you can be buying and have a greater pick of homes, but you're going to be competing with more people over that same inventory. And then last but not least, don't confuse less competition with no competition. So yes, we are seeing less competition traditionally in the fall and the winter months. However, as I said, the average days on market is still 11 days. We're still seeing where sellers are getting 100% of their asking price. So it's still a very competitive market out there. But if you can find something in the fall and the winter months, you're going to be competing against less buyers than you would, let's say, early spring next year. Hopefully you guys found that useful. If there's any questions, concerns that we didn't address, feel free to throw it in the comments, shoot me a DM. If we can help you with your next purchase or sale, give us a call, shoot me a DM, send a smoke signal. Thanks for tuning in. Look forward to seeing you next month.